In the past week, there has been a stunning change of character in the stock market. Last Thursday, when I recorded our prior episode, and this is an extension of that episode, we were on the verge of a major shift from an uptrending market into a correcting market, and we talked about it and documented it at that time. But now much has happened, so let's bring things up to date, and then let's talk about what could happen from here. Hello, I'm Bruce Fraser. Welcome to Power Charting. Last Thursday, while recording this episode, the stock market went into its corrective mode and was down 300 or more points right about the time that we started to do this recording. Well, today, February 27th, Thursday, we have a market that is down in the area of 600 points on the Dow and is continuing its long decline, which has gone on for the entire week since we last had a recording on power charting. And so this will be broadcast on Friday at 3 Eastern time. So keep that in mind, but I will bring markets up to date as we go along here today. So here we can see that this is the New York Stock Exchange Bullish Percent Index, and this is an index of the all the stocks on the New York Stock Exchange with a point and figure analysis where it actually counts the percentage of stocks that are on bullish percent buy indications as determined by specific criteria in the computer. And so this is a very interesting way to look at the markets, and it is a breadth indicator. So you can see here, and what I'd like to really emphasize for us as a breadth indicator is to look at periods when the bullish percent goes below, in this case it's a 20-day moving average, and it starts to decline in a market that is going sideways or going up, creating what we call a divergence. And so here, for instance, and sometimes it's not even a case where it's a divergence, here you can see that we have a decline and the market is declining at the same time. And this is an environment where fewer and fewer stocks are in their bullish uptrends on buy signals. And this tells us that the market internally is deteriorating. So here is a great example, and we have documented this in blogs and so on, but you can see here the bullish percent peaks out at a relatively low level, and this is in the mid 50% range. It has a lower high, turns down, the market is in a topping mode, and then it starts to cascade lower, even though the market itself is trying to go down, but is doing so haltingly. But this completes a bearish indication, a bearish condition in the market, and then the market just goes into a free fall. So these are the things that we need to be aware of and concerned about. Here we can see this very sharp turn in early 2018 produced a pretty important decline in the market and set up a range-bound condition. Now here, look at how the market is trying to go up. This is the S&P is going up, and the bullish percent is making lower highs, is not going up with the market, and is indicating in mid-2018 that there's internal deterioration in the market. And then there's just this really severe breakdown, and we recall that this was the end of 2018 decline, put in a significant low below 20% on this indicator, but this sheer free fall. And as long as you have a market that's in a free fall like this, you want to just get small and be very, very cautious. And so This is the nature of it. You can see series of lower highs here as we go through the mid 2019 period, but then a higher low and turns up. And so the way to use this on the upside is to see that it's turning above its moving average and it's in a northbound direction. And this is an environment where the number of stocks that are in bullish uptrends is expanding. So let's zoom in here. This is just going back a year. And what we saw, this was the chart I was going to show you last week, was that we had a breakdown, beautiful uptrend here since October, a breakdown in this indicator that took place in January. And look at the rally that we had in, I want you to see this clearly, so I'm just going to erase this ink and start over. And you can see here that this rally is very lackluster as the S&P is pushing up to new highs. Big divergent condition, and this is something to be very cautious about. Now I'm going to show you this up to date, actually into today, Thursday, and this is where we are now. You can see that once the decline starts to really get going, it can just be in a free fall. So this divergent condition wasn't a warning, an indication of trouble underlying the market, and the breakdown occurred. And you can see here that the index itself has gone through, as we all know, a major correction, and the percent of stocks has gone from as high as 70% roughly back in January, and now it's down to the mid around 38%. And so this is a very severe correction, and very few stocks are in bullish uptrends according to this indicator. So this is one for you to keep track of, keep an eye on, and use these swings for your trading purposes. And I think this will serve you quite well. So with that, we will move on. I want to show you just this very long-term chart. I showed this to you at the beginning of the year. It's up to date through the 25th, but the point being, these are monthly bars, yearly bars, you know, so this is 2019. Here we are in 2020. We can see that we pushed up into a very long term uptrend overbought condition. This is the overbought trend line, and we pushed up and touched it in 2019, and we said this is going to produce some kind of a resistance to prices going higher, and may even produce a correction. Well, you can see even with this big correction we've had that it's a very tight little bar in 2020 so far, but we have the whole year ahead of us. So just the point being that this continues to be an area of potential resistance for some period of time. Now let's zoom in from the yearly look and zoom into the weekly look, because this is telling us an awful lot. And here you can see that this is a trend channel that was constructed in 2016. This is the demand line, and then this is the overbought line. And look at how the demand line was broken back in mid 2018 in the big drop from the October highs, September, October highs down to the December lows, which we're calling a shakeout. Since then, we've had a glorious uptrend, but look what's happened is this uptrend has only taken us up to the long-term 2016 demand line. We had a throw over of this in January, which we're going to call preliminary supply, another thrust above into an overbought condition in February, and we can see this closer, and this overbought condition has produced a reversal back into the channel. Well, there's a shorter term channel at work also, and this channel here goes back to the summer, and here's our demand line, here's our overbought line on this point here, and you can see that on two levels of trend analysis that we have a throw over and an overbought condition that's taken place. And so here, look what's happened through today, intraday, and that is that we have taken out, very sharply taken out the near-term demand line that goes back to May and then July. And you can see that I would suspect there's a good chance that we could attempt to stabilize somewhere around this demand line for some period of time. And I have other reasons for thinking that, which we'll get to in a few minutes. But anyway, this I think is a very interesting chart. And let me just say this now, and that is, excuse me, is that this is the beauty of StockCharts. StockCharts.com has a wonderful annotation tool. And what I do is I keep these charts that I've annotated together so that I can always be updating them and seeing where these trend lines are going and where the analysis that I've done, the Wyckoffean analysis, how it's working out. And then these charts are brought up to date, and I use these charts over and over when they're relevant. And this chart is very relevant right now. And so it's most interesting, and I'm sure we'll come look at it again, but this is a very interesting juncture. And it also shows you just the sheer magnitude of the drop that we've recently had. Look at the drop in January, February of 2018. That was a substantial drop. And this drop appears to be a bit larger than that. It is not yet as large as the late 2018 decline. And I'm not sure that that will happen. And we'll talk more about that. So with that, let's move on. This is the Dow Industrials, and all I want to do here, because we've looked at this chart a number of times, two levels of trend channel work. This goes back into 2019, and you can see here that there's a demand line that goes down to the 27,000 area, roughly, overbought line. Just like the S&P, we have two throw overs, January, February, overbought condition, throw over and overbought. We have been using this chart now for a while. The other thing that's most important about this is that I put on here the point and figure levels. This is the high, 29,568 on this bulge over the overbought line. And we had pointed out last week that that took it above the point and figure count of August. That was a very important swing trading count, and then also above the high count of the accumulation area back in late 2018, early 2019. So confirming point and figure counts, both achieved, overbought, throws over, and finally throws over at the second bulge above the overbought line into a throw over condition. And so at that point, the market pulled back into the channel. And now we're going to look at what happened next. Make sure you're sitting down. And this is through today. And you can see, and this is actually that chart that we looked at was the day that we were doing our analysis for the last week's show. And I strongly encourage you to go back and look at last week's program, because I think there was a lot of good work in there. But you can see the break of this short-term demand line, the break of the long-term overbought line, and then just the sheer failure of the indexes off of that level, which it was in, we had said at the time that we had used up the fuel in the tank. And so the ability of the market to go down. Now, the coronavirus gets talked about as being the event that has caused this. Well, we've known about coronavirus now since almost the end of the year. So the coronavirus has been out there looming. I don't think anybody was confused about what a big risk it was. It is tragic, and I hope everybody stays healthy and safe. And that this thing gets resolved very, very quickly for the sake of everyone. But at the same time, what is it that caused the markets to go down? And this is our Wyckoffean orientation. We are tape readers. We are chart readers. We look at what the tail of the tape tells us about the condition of the market. And so here, what we can say is that the market used up its fuel that it had in the tank for the rally that we were in. The reason the market is falling so severely is the fact that there was just extreme positive bullish speculation. There was the fuel that was generated in the year 2019 was used up as measured by the point and figure counts. And now the market needs to create new fuel for a new bull run, or we may get the conditions for a bear run. A little too early to tell, but this is why we read the markets and look at the present position and the probable future direction of stock prices from the market itself, and we don't get caught up in the news. We see the news for how it affects people's behaviors. Okay, so with that, here we are below this demand line. So will the market stabilize here? Well, we'll ask that question here in a minute. Okay, now you've seen this chart before, and I want to just I'm going to go ahead and put in these annotations so that you can see what our thinking has been. And so here, this was the chart we did at the end of 2019 for our year ahead look. And so far, it appears to me that this is what we have. Here we are, we're in the end of February. Saturday is the 29th, leap year and election year. This is 116 years of election year data. So this is obviously every 4 years, but averaged together. So we know the market isn't going to act perfectly like this, but the market has a tendency to act consistent with this phenomenon of an election year. And so we're looking for conditions that would support this. Well, we've had a buying climax. We've had those 2 throwovers. They took us into February. So the buying climax happened in here somewhere, right in here. And we're getting a steep decline. And we said at the time that the reaction off of that climax was going to be scary, nasty, scary. And this is certainly the case. Now, the coronavirus, I want to come back and talk about the coronavirus relative to market sentiment, but I'll do that in a minute. So I got to remember that. So here we are somewhere in late February, early March, we'll probably get a good automatic reaction low, and then we'll get another attempt to rally, I believe, but we're going to wait and expect to get a cause. This is very important that we want to see a cause built. Here's like a cause, here's a cause, and something that we can count the point and figure and get a projection, just as we were able to count the point and figure up here and get a projection down. And I'll show you that in a minute. Okay, I'm going to pause for a second and clear my throat. Thank you. That was really just an excuse to get a big swig of coffee. Okay, so now keep in mind, building a cause, we look for the market to tell us where it wants to go. And so with that in mind, let's keep going. But I just want to point out that we're going to, according to our election year forecast, and we forecast for fun, we use our market analysis to tell us what to do. But in the course of the first half of the year, we're expecting a trendless market. And so let's hope for that, because right now the market looks like it really wants to just trend downward. But that can change very quickly. So with that in mind, we'll go right past all this stuff. This is the structure that we're dealing with now. Here is a reaccumulation trading range, conventional labeling, and Dr. Pruden created this. And Dr. Pruden, we know that you're with us here and helping us and guiding us along in our analysis. And so we have here end of the year, big rally from October into January, February, buying climax, and then an automatic reaction, and then a range-bound condition. And this is the Wyckoffean view of the area that we're expecting in the first half of 2020. And so this is what we're looking for, is something akin to this. It's going to start off being very, very volatile, and it's going to become less volatile as you go through the reaccumulation trading range because absorption is taking place. But at first, the volatility is deep and scary. So, and we certainly are experiencing that right now. Okay, so with that, let's go on to some point and figure work. This is the chart that we used last episode, last week, and at the time, it was just getting ready to go into its downward spiral. And if I remember correctly, we were right in here, and the market intraday had gone down, Dow down 300 points, actually right before we started broadcasting. So anyway, this is 30-minute data, 3-box reversal, 18-point box size. Now, I've left the box size the same because, and this was based on ATR scaling at the time, but ATR scaling would change dramatically on this chart with these conditions set up because of the huge volatility that ensued following. So you can see here that this is classic distribution. So we have climactic surge, automatic reaction, and then we have an upthrusting action, a big sign of weakness. We can see volatility coming in. Classic distribution. This is a run up into last point of supply. Look at how it matches this climax area here. They equal each other. Classic relationship. And then just a collapse out of the structure, and then notice the rally after an original attempt to get back into the distribution area. The rally becomes very lackluster, muted, and this is the second last point of supply, which results in an extreme downward move. And then notice this, sideways, no lift, supply is present, there's trouble in River City. And so we take counts. This is the count from this last point of supply over 43 columns times 3 times 18. And at the time I said there was over 2,000 points of distribution count in the structure. Well, it ended up that this was 2,322 Dow points of count. And I'm going to show you where that went. But also I want to show you this bigger count, which goes from this area, which we will call the ICE. And you take this over, this gives us a very big count, 53, and that actually is 2,862 Dow points. So let's see where we went. And so we can see here, let me just zoom in because this information is so hard to see. And so you can see here that this is as of, I think, through yesterday, and you can see that we hit these counts, missed this one by a point, but huge volatility. And this is always, we should expect huge volatility in the downward move. And that's exactly what we're getting. And look at this climactic type volume that's starting to show up. So what we want to see is, as prices are trying to go down, anytime you see high volume in very sharp declines, expect the market to want to test those lows and continue to see if more supply can be brought out at these low levels. And in fact, there is more testing going on. We can't begin to know if this is the end of it or not. And so in fact, let's go back out. This is what actually did happen. And so we have this area over here, and then we had today additional weakness. Now look at the volume. Volume is starting to really dry up. That's a very encouraging sign that at least temporarily the market may be exhausted and tired of going lower. And then let's zoom in, and we can see here that this is the count roughly from that bigger count objective area, the 2,862 points, went roughly to 26,200, 26,700, and you can see after going through the lower objective here on very low volume that the Dow bounced back quickly back into the range of the count. Now, I would expect some time spent building a cause. It doesn't have to take much market time because of the extreme volatility. You can have a market that builds a bit of a cause for a rally very, very quickly. So it may be difficult to see outside of intraday data, but there could be a pause. Now, this may be redistribution, reaccumulation. It's too early to tell. We're just going to be watch very, very closely. But this is encouraging. Our biggest, most aggressive count across here has been fulfilled and appears to want to come back and reside in this area, very low volume. So this could be a good early sign that the market is going to calm down a little bit for a while. We don't know, again, whether this is going to be redistribution or possible accumulation for a bit of a bounce, but we would expect it to be quite volatile from here for a while. And so with this, and look at this big gap in here. So down 518 points when I produced this chart today, and a gap and a very sharp drop into our target zone. And you can see this beautiful, look at this gorgeous uptrending channel from October, and we're running out of time. This beautiful uptrending channel is just blown apart, and all of this gain is lost in a week. So again, here is that count and where it went, and this is the Dow Industrials both on the same page. And then here's the S&P version of that. You can see here that there's a beautiful distribution here. We'll study this later with an upthrust at the end and a complete failure, classic upthrusting action. We really want to dig in and zoom in and look at that, but look at how much of the gain from October has been destroyed. And then here, this is the put call. The only point I want to make about the put call is just that on a 10-day basis, we get really good lows when we get up into this area of around 70 to 75. And so this zone here, and maybe even higher than that, which shows a lot of put buying. And we are on a 10-day basis, not there yet, but you can see that on these one-day spikes are going to ultimately produce some high pessimistic readings. And so this will, I think, help us to be very patient and wait for the really good setups. And so here we can see that. So we want to get up into this zone here again. The fear and greed index, in the little bit of time we have left, you can see that it's dropping precipitously. Here it's down to 21. It got down to 3, I think it was, back at the end of 2018. So it could go a lot lower. The coronavirus creates a top-line news event that sets up the market for an important psychological low. And I think that to get down below 10 in this fear and greed index, and just search for CNN fear and greed index, and you can see this in all its components. And so with that, we are running out of time.